So if you have an aging parent, you might think the most responsible thing is to put them into a nursing home, or maybe that's your only option. But what if I told you that this well-meaning decision could destroy your family's financial future, or strip your parents from their independence, and also leave you with nothing to show for all of the money that's been spent? So in today's video, I'm going to go over exactly how to keep your parents out of a nursing home, how to protect your money, and also how to buy a home using a special mortgage program you've probably never even heard about, even if your parents don't qualify on their own. It's called the Family Opportunity Mortgage. Now let's get into it. So this mortgage program allows you to buy a home for your parents using a very low down payment, and also you'll get a lot lower interest rate as well. And the best part is they don't require you to live in the property. They also don't require your parents to co-sign on the mortgage as well. And so a lot of people automatically assume that if you're going to be buying a house that's for your parents that you yourself is not going to occupy, then the down payment automatically is 20%, and that is not true using this specific type of loan program. Also, a lot of people think that this is a very hard loan to get. It's a very specialized program. It's also not the case as well. You want to work with someone that knows the ins and outs of this program and can code it correctly for the mortgage company. Now let's go over how much money could cost you without using this loan program. So a nursing home can cost anywhere from $5,000 to $10,000 a month, which over the course of 3 to 5 years, that can equate to $250,000 to over $500,000 of money that's been spent. As opposed to using the Family Opportunity Mortgage, you actually own the home and you're responsible for the monthly mortgage payment, which on a $400,000 house, that can be around $3,000 a month. Then you also are building up equity as the home appreciates year after year. You also get a lot of tax benefits of owning a home as well. And a big mistake is families spend years throwing out money on home care, not realizing that they could own a home, and you're also building up equity. Now let's go over who can qualify for this mortgage program. So you yourself will qualify as long as you have a parent or disabled child that cannot qualify to get a mortgage by themselves. Either they don't have a credit score or they don't make enough income to qualify. Just as long as they themselves are going to be occupying and living in the property full time, then the banks can use your income and your credit to qualify. Now, a lot of times people assume that they themselves are going to have to live in the property in order to use this program to get a low down payment, low interest rate. That is not the case. You yourself do not have to live in the property. Now, before we go into why this loan program is even more powerful than what many people realize, make sure you hit that subscribe button so you get notified every time I put a video out. So now that we went over buying a house for your loved one, now let's go over some home health aid costs. So a lot of times you can look into different options, and this all depends on how much need and how much attention that your loved one needs. So if you're looking at someone that can come in part-time, a lot of times this is still cheaper on a monthly base than going to a nursing home. And sometimes you can even get Medicare to cover these options, and even though you're paying for this service, you are still building up equity, and you have to make sure that you're weighing the pros and cons of having them in a nursing home with 24/7 care or having them in an actual home itself, and you are paying that bill. Now, a common mistake is people automatically assume that a nursing home is going to be a lot cheaper for them. Again, at the end of the day, this is going to depend on how much care and attention and how much your loved one needs. So some of the benefits of using this loan program is you're going to get a lot lower interest rate because you're buying this as a primary residence, as opposed to if you're buying this as an investment property, the interest rate can be anywhere from 1, almost 2 points higher. Also, the down payment, you only need 5% versus 20% for a down payment. There's also, you're building up equity. Real estate appreciates at least historically 5% every year. You also get a lot of tax benefits. You're able to write off the property taxes. You're also able to write off the mortgage interest that you paid within that year. And then you also get to keep full ownership of the house because it's going to be your name and you're going to be the owner of the house. It's also a safe and familiar place in which your parent or disabled child is not having to move year after year. If they were in a care facility, they're going to be in that home and they have a familiar place. Now, a lot of times people assume that they have to buy this as an investment property because they're not going to be the ones living in the property, and that is not the case with this loan. Again, this can be used by a primary residence because the parent and disabled child will be living in the property full time. So here's how much the Family Opportunity Mortgage can save you when buying a $450,000 house. So minimum down payment is going to be 5%, which is $22,000. Now, if you're going to buy this as an investment property, which you would because you yourself are not living in it, then 20% would be the required down payment, which would be $90,000. Now, family opportunity mortgage, you'll get an interest rate in anywhere, this is depending on the market, anywhere in the low sixes, 6.5%. Interest rate on an investment property right now is mid 7.5. Now, your payment using the family opportunity mortgage is going to be around $3,200, this including taxes, insurance, and with an investment property, it's going to be around $3,067. Now, the family opportunity mortgage, it allows you to put down a lot less. So even though that mortgage payment is a little bit higher, you're able to save that cash for other things. You're also able to get a lot lower interest rates. So you're going to be paying a lot less in interest over the life of the loan. Now, here's the comparison using a $600,000 home. So in the family opportunity mortgage, you'll get a lower rate. We'll say in the mid sixes, 6.5. The down payment is only 5%, which is going to be $30,000, and your payment is going to be around $4,200 per month. Now, with an investment loan, you're going to get a higher interest rate in these sevens. Your also down payment is going to be 20%, which is going to be $120,000, and the payment, because you're putting down such a large down payment, is going to be around $3,900 a month. So even though the mortgage payment is a little bit more, when using the family opportunity mortgage, you are not having to pay as much as a down payment, and you're also paying a lot less interest over the life of the loan. And here's the overall strategy. So you're buying a home for your parent or disabled child, and they're going to be the ones that's going to live in the property full time, and they're essentially going to become like your tenants. Then over time, because real estate appreciates at least 5% annually, your value of the property will be increasing. So if you ever need to sell the property, or then you can either, if they ever want to move out, if they have increased needs in care and have to move to a full-time care facility, then at that time, you can either sell the property and you have equity, or you can also then turn it into a full rental property at that time. And the reason why most lenders get this loan program wrong is because, number one, you're not going to be living there, and you also don't have a co-signer that will be living there. So what they end up doing is they automatically put this in as a second home or an investment property, which is going to trigger a lot higher down payment and, of course, a lot higher interest rate as well. So they must code it correctly, and they must know how to get this done in their system in order for this to get treated as a primary residence without you yourself having to occupy the home. So you want to make sure that you work with a lender that knows the ins and outs of this loan product. So here's how to get your loan approved. So number one, the credit score needs to be at least a 680 plus. This is going to follow regular conventional guidelines. Then as far as your income and debt, that's going to determine how much your buying power is, or how much you're going to get pre-approved for. So generally speaking, you're going to get approved for anywhere from 3 to 4 times your income, depending on how much debt you have. So if you make around, let's say $100,000 for the year, you could probably get approved if you have very little debt, around $400,000. Now again, you want to work with a lender or broker who has access to this program and actually knows the ins and outs of this program. So if you're planning to buy a house and you want to know how much buying power you have, make sure you hit the link in the description, schedule a call, and I'll be in touch.